Hey there, Wealth Press subscribers, viewers, traders, and investors. It's that time again, time for the weekly wrap up, and I'm joined as usual by Roger Scott. Roger, how are you today?
I'm doing great, James. Thank you for having me on.
Fantastic. Roger, it's been quite an interesting week in markets in that there seems to be a bit of a reversal underway in certain sectors. Is it time to go traveling again?
Well, I'm going to tell you, I've been very, very skeptical about this whole thing, and I've been very, say, on the sidelines. But it looks to me like the market is showing its hand. I just looked at the S&P 500. We've got stocks like Marriott, Tripadvisor, Expedia. All these stocks are now in the top 15 of the S&P 500 stocks, something we haven't seen in a very, very long time. And that's new, and that's something we have literally not seen. We had a lot of retail stocks dominating the S&P 500 over the last several weeks, last several months actually. But this time we're actually seeing. Let me just give you a few of these. We've got Norwegian Cruise Lines. We've got let's see here. Sorry, I got the wrong index. Now I got the right index here. Expedia, Marriott, Ulta beauty shops. Now this Ulta Beauty used to be a very strong stock till the COVID vaccine hit, till the COVID, the lockdown began. And now it looks like people want to look beautiful again, get cosmetics. Everything is pointing, all of these, Trip.com, Travel Advisor. Anyway, the bottom line is the markets are speaking to us and they're telling us right now that certain stocks are coming back and they're coming back hard. This is the first time I've seen a stock like Marriott on my top 15 list in over a year.
Yeah, no doubt. So then is it time to pile into all of these stocks that have been beat up, the travel stocks, the shipping, the cruise ship stocks, the airline stocks?
Well, it depends. It depends on your time frame. If you are a short-term trader or a swing trader, I would say maybe. But if you're a position trader, I think we should wait a little bit. And the reason is, I think the market is setting up for potentially more downside, a little more corrective pressure. The inflation, the air has to come out of this market. The NASDAQ stocks are grossly overbought right now. The number of stocks trading above the 200-day moving average is still in the 75th percentile. And we need to see it go down to the 40th, 30th percentile before moving back again up. So I would be a little cautious right now, especially if you're a position trader. If you're a swing trader, you're getting in, you're getting out, you have your stop loss, you got your profit target, volatility's there. It's a great time. But if you're a position trader, there may be opportunities to get in at a better price than right now. But the bigger takeaway here, James, in my opinion, is the fact that the sentiment is changing, that the fact that the markets are finally looking to the next phase of opening up instead of the fear-based COVID environment.
Right. Well, that's intriguing. We're also waiting on the $1.9 trillion stimulus package from the Biden administration. And just this week, the Fed reported its balance sheet, which has now touched an all-time high at $7.6 trillion, a large portion of which is mortgage-backed securities, or a proportion of, not necessarily a large one. But so does that sort of act as a inflationary influence on the market and asset prices at this point, in opposition to the corrective deflationary sort of pressure?
That's a great question. And yes, obviously, look, America has taken over the last year a lot from its future. There's just no denying it, right? We ate a lot of what was coming to us, and we have to find out a way to make it back. We have to kind of grow those plants and yield those fruits. And, we've taken a lot of energy, a lot of economic energy out of this market, especially US. Think about it. U.S. saw the highest death rate from COVID around the world. It's unheard of. We're going back to being a third world country, especially economically right now. So yes, I believe it's going to impact into the U.S. economy substantially. But the thing about it, James, is the government and the economic policies that we're seeing right now have shifted from long-term view to short-term view. So right now, basically, the Fed is saying we're not going to do anything right now, and people are taking it and they're running with it and they're not thinking ahead, which is really puzzling, but it's been the trend. You and I have talked about this several times. People are kind of taking the future and they're kind of just saying, there's no pink elephant in the room. It doesn't exist. And that's very, very worrisome. And ultimately, it'll come to bite us in the butt. What I believe is happening is the economic nature of US is based on growth. And I think there's just a very fundamental assumption at this point that America's companies are going to grow and ultimately we're just going to get out of it. And the growth is going to overtake inflationary and all the measures that are bogging us down, and we'll get out of this. But it doesn't seem to be happening right now. And I don't know what it'll take us to get out of that mess, but there's no catalyst right now that I'm seeing that'll get us out of what you're talking about right now without a great deal of inflationary pressure over the next several years.
Yeah. And also the 10-year Treasury passed 1.5%, which is suggestive, to say the least, of perhaps a little bit of disbelief in the Fed's ability to curb inflation with further stimulus. And is that a concern?
Absolutely. That's widening the curve. As you know, the short-term rates, the Feds come out and say short-term rates stay stagnant. We're not going to do anything. We're not budging. Meanwhile, we've seen the long-term rates go from 0.94 to, as you said, 1.5 in just a few months, or maybe even less. I mean, very, very short time period. So yes, there is a widening. The curve is not flattening. It's definitely widening. And widening of the curve between short-term rates and long-term rates is extremely inflationary. And it's clearly sending a message to the stock market, as we have seen over the past several days. We've seen this, not several days, but last few days. So yes, absolutely, unquestionably, this is a sign of trouble. And by the way, just for the record, a lot of people are saying, inflation, what inflation? Here's where the problem lies. And I've talked about this with Jeff, and Jeff Zenaneri actually gave a few good examples on this. We were talking about it, and I think we are seeing inflation. I think we've been seeing inflation, but I think what we're seeing with inflation is mimicking what we're seeing with the rest of the stock market. It's lopsided. In other words, you and I were talking about, I remember last February, a year ago, you and I were talking about lumber prices and how you couldn't get lumber prices and how nothing has changed. It's only gotten worse. Building supplies, forget about it. I didn't forget those conversations you and I were having. So commodity prices are going higher. There's no doubt about that. Price of coffee, price of goods. But at the same time, you're seeing certain things, the shortage, and I'm going to tell you, the shortage of semiconductors around the world is not going to help this either, But what we're seeing is we're seeing very, very strong demand in certain sectors, and we're seeing very, very weak demand in other sectors of the economy. For example, let me give you a very simple example. Me and my video guy were just talking about this over the last few days. Clothing. It has been cheaper and cheaper to produce clothing. Big manufacturers like Ralph Lauren are making their clothes in India right now, Bangladesh. Okay, so they're able to manufacture their clothes for a fraction of what and with all the machinery and the international global commerce, they're able to manufacture these polo shirts probably for 50 cents, if I had to guess. Okay, this is just my guess. And they're still selling them for the same prices that they were selling them 15 years ago, 20 years ago. Meanwhile, technology, you've got state-of-the-art Apple computers and PCs with these, they're like $4,000, $4,000. So in some aspect of the economy, prices have gone up substantially. In some aspect of our commerce, prices have gone down substantially. So you're seeing a lot of that in the economy, and you're seeing a lot of that in the stock market as well. Just take a look at the cloud over the last year. Prices quadrupled for cloud services and for cloud stocks. Meanwhile, certain stocks like cruise ship stocks and airline stocks have gone down substantially. So you're seeing inflation, but you're seeing it in a very lopsided fashion. And I think that's throwing a lot of people off. And the fact that interest rates, short-term rates are low is also adding to that confusion.
Right. I couldn't agree more with you on that. Like, if I'm just going to throw up a chart here, this is the copper futures chart, front month. And as you can see, it's at 416 today, but it touched a high of over $4.30 here, which, if we go back in the timeline, is the highest it's been in years. In fact, the last time copper was up in this price range was back in the heyday, the commodity heyday of 2011, just before everything went south. So you've got copper futures definitely in an inflationary mode. You've got, let's see here. What else did I have? I had, that's steel. I've got lumber. These are lumber prices right here.
Yeah.
No, that's copper again. This is lumber prices. Random length lumber futures, continuous contract. Again, at all-time highs. So if that's not inflation, I don't know what is.
Exactly.
And it's just a matter of time.
Exactly. So I'm so glad that we're able to look at these charts. Actually, very helpful. Thank you for doing that. And yeah, but at the same time, and I'm not trying to put you on the spot with charts and all that, but at the same time, I'm sure you could show us some charts where prices have gone down. And, so the point is, it's very lopsided. It's not inflationary in every sense of the word, but there are some insane pressures. And if you look at producers' prices, if you look at the index, it's also showing some signs of inflationary. There's no question about it. And the only question, if you're an economist, you may say, well, inflationary measures that we're seeing right now, or pressures that we're seeing now, are more because of the lack of the supply and demand chain because of the COVID, and not the fundamental economic factors. But I disagree. I think because look, as we pointed out in the beginning of this discussion, look at the stocks that are right now starting to come back up. These are not stay-at-home stock. Marriott is not a stay-at-home stock. Yeah, Expedia is not a stay. I mean, that is the definition of that's like the opposite of Peloton and Zoom, right? Expedia and Marriott. Peloton and Zoom are no longer leading that chart. And that's the NASDAQ 100 I'm talking about. That was the NASDAQ one. That's why I couldn't find them at first, James. I was looking at the S&P 500. Then I realized these are NASDAQ stocks, Expedia and Tripadvisor. So the point of the matter is, there's definitely a change happening right now. But again, there's so much volatility, and the market has been beaten so out of whack in terms of the different sectors and the different commodities and interest rates, that it's going to take some deflation in terms of the market's actual performance, not deflation in terms of interest rates or prices, but deflation in terms of the outflow of price. We need to see some of it. It's too much too fast. I think we've seen too much upside. I think that certain sectors are due for a bit of a deflation. I think some of the large cap NASDAQ stocks have outrun themselves. So I think we're going to see sector rotation. I think we're going to see different sectors lead over the next several months. We may see some more congestion and volatility in the NASDAQ and in the overall market.
Yeah, you bet. Well, just for argument's sake, and here's the chart of the NASDAQ 100 today. And this is here's February back here.
Yeah.
And you can see that we've sort of exhausted the impetus of the last inflationary stimulus round. And the NASDAQ, like, it seems to be almost responding to what you're saying as you're saying it. It's in a sort of deflationary mode right here. And I guess that's largely due to, money rotating out of the stay-at-home stocks, and yet to really go into the traditional drivers of the NASDAQ 100 that are still at the very beginning curve of their recovery cycle, assuming that continues.
Yes.
So now all this is it's not, people say this is driven by pandemic economic pressures, not inflationary macroeconomic pressures. You and I just both disagree with that. And I think that this is the proof of that. You know, the NASDAQ would not be selling off if that were the case.
Exactly.
So my question for you, if this, like we're seeing the commodities rise, we're starting to see signs of a deflationary corrective phase sort of strengthening in the major indices, unlike the corrective sort of gut-wrenching drop we saw back in March last year after stimulus. This time, it's like it's taking its time to set up, and it's got more of the contours of a trend as opposed to a sharp corrective drop that from which a quick turnaround is going to result. This looks scary to me.
Well, let me add one more thing to your fears, and I don't want to get people, you know, I don't think we're having a major crash, but we also had really good news yesterday. The GDP was solid, and the unemployment rate was down in the 700s. Market did not react to that positive news at all. Number two, earnings was very positive. The new earnings data on the NASDAQ blew everything out of the water by a huge margin. And yes, we know those numbers have been beaten down to death, but still, they were a lot better than expected, substantially. And we're about to get more stimulus money. So the point is, the market is not responding to positive news. And that's probably the worst thing you could see. And that is very, very, when the market is selling like this and there's positive news and it's selling in a concentrated way, that's not good. That is that is very, very negative. Because in one respect, James, the Fed has backed themselves into a corner, because what are they going to do? We're not going to go lower rates. We're pretty much there right now. We're not going to go negative, because if we do, the US dollar will crash, because everybody and their mother will start taking money out of USA. The only reason why money is being put into USA is because the interest rates are still positive. So the US dollar it'll I don't even want to know what's going to happen to the US dollar. But the Fed knows that, so they're not going to do that, because it'll just create more work for them. So my theory right now is the market is just overstretched out. I've been talking about this nonstop. This is very, very healthy. And remember, the market has been completely out of whack. We've been seeing sectors that shouldn't be rising, sectors that should be falling, going up. It's been just a roller coaster in the market. And the way the market goes from being very fragmented to being rhythmic again. And I'm a technical trader, so I look at rhythms of the market. And when you have a rubber band like this, you know, stretched out like this, there's only so much it can do. It's been kind of like this, push and pull, and eventually that rubber band breaks or snaps back. That's where we've been. You've got 85-90% of stocks. You have momentum levels on the 200-day line. 2 times we've been here in 20 years, James. So this is very good, healthy, normal, and natural, and very, very expected. And I'm expecting the number of stocks that are trading above the 200-day moving average to come down to about 40th percentile if this continues before we go higher, which will put us squarely below the 200-day moving average and shake out the weak hands, and we'll begin going higher once again. The Fed's not going to let this market crash from these levels, but this is really, really healthy right now and much, much needed.
Sure. So is it your expectation then that the commodity prices will start to decline as the process of correction, shaking out the weak sisters, as it were, nears its conclusion? Will we see the reversal in commodities, or commodities? I mean, the action in commodities across the board has been, it's clear that there's a major accumulation going across markets in the commodities sector, which to me suggests that the biggest capital pools in the world are positioning themselves for a protracted state of discount in the US markets on asset prices in the stock market. So, I mean, though there's all these conflicting, sort of competing signals and pressures out there, and our job obviously is to figure out which ones will prevail and what the contours of the future asset prices will be, which we've been pretty good at so far. Pat on the back for ourselves, but you know, that's the big mystery, looking out on the timeline.
James, here's what I think is going to happen. I think what you just said would be 100% true. I think under normal circumstances, we would see a downdraft in the US stock market, and we would see commodities go up a little bit more or stay around the current levels. In this particular case, there's just too much liquidity coming into the stock market. Direct bond repurchases, the Fed has spoken. Nothing stimulates global stock market more than the Fed shoving money and buying, doing it. So what could have been a bear market is going to be avoided by the Fed and what the Fed is putting into the market right now, and all the actions that they took almost a year ago. As I've been saying, that a lot of the next couple of years was shaped by what happened last February and March, by the beginning of that, of the Fed taking measures, by interest rates. Look, let's be honest with each other. Even if interest rates spike, short-term, long-term rates spike, they're still near historic lows. We're still very, very low. We've got a while to go till interest rates are at a 10, 12% rate. So I think, and we also know the Fed is going to do everything possible to keep the stock market from unwinding, especially right now in this economy. So I think we're going to see a little both. We're going to see some inflationary measures in the commodity market. We're going to see still some very strong demand. It may cool off a little bit in the lumber market. We may start seeing a cool off in the market, in the housing market, because there's a certain level, and if the interest rates go above that level, prefab homes, home builders are just going to stop building. We've seen that before. So we may see some relief in the home building sector, which actually was the first one to rally in terms of the inflation. So that may start cooling off, because it's time for real estate to start cooling off, especially with rates beginning to rise. So that may be a precipitating factor to some deflationary measures in some aspects of products. But again, I don't see that with food. I don't see that with basic supplies. I see that limited to basic materials and industrial stuff, not foods and goods. So again, that's just my opinion on that. So I think we're going to see a lot of volatility, but a lot of shakeouts in the stock market. A lot of the large cap stocks that are overvalued are going to be eaten alive. But ultimately, the market is going to remain within the 200-day moving average. We're still going to be in a bullish environment for a substantially long time. And at the same time, we're going to have some inflation.
Yeah. Interesting. So I guess we're pretty much in agreement, as per your previous comments, that the Fed's only weapon is stimulus. So my thinking sort of wanders along this sort of line of, well, at what point does stimulus stop to have the effect of, driving liquidity into markets? Because, I mean, valuations are already way overdone, overbought, overpriced. Like it's just insane. So, I mean, and now the money is chasing commodities because there's some trepidation about the asset prices across the technology sector and associated landscapes. So then the curiosity for me is, people say, well, this is going to cause inflation. It's like, well, excuse me, but we are actually, if you look at the last 10 years, we are in a hyperinflationary trend. If you look at the curve on the money supply globally, it goes from 30 degrees to 90 degrees. If you look at the price of commodities now, and this is the true sign of the effect of long-term quantitative easing, the commodity prices have started to angle into a 90% angle, and 90-degree angle rather. So this is, to me, these are all the kernels of an extreme precursor to hyperinflation, where suddenly the Fed's not going to be able to print money fast enough. Prices are going to start rising so fast that this is the verge of the whole system unraveling. And I look at the interest rate, it's only 1.5% today, but that was a very curious jump considering we're still sitting in front of $1.9 trillion of stimulus. Why are interest rates going up? That should not be the case, unless there's some serious trepidation about the ability of stimulus to continue to inflate the market. And that's, again, as I look out across 2021, that's the biggest threat to me, is that we're actually in a hyperinflationary precursive mode.
Well, let me back up for just a second. If you remember last year, wasn't that long ago, the Fed announced they were lowering rates 3 times. The first time they said they were doing it, the market rallied like there was no tomorrow for several days or weeks. It was a big, big move. The second time they said it, it was, a couple of weeks. There was some, and then the third time they said it, remember what happened? It went the other way.
Yeah, right.
There was no reaction. And then after that, the bonds just, they went south, and interest rates started rising. So I'm kind of seeing a similar pattern this over the last, say, 9 months. First time the Fed put money into the market, said we're going to give stimulus, the market rallied like there was no tomorrow. We all, from March to end of the year, it was just crazy. It was bull market. And then the second time they said it, the market moved. And then the third time they said it, which is supposed to happen, not much is happening. Opposite is happening. So my point here is the market is not responding to stimulus, which is why I said they're kind of putting themselves in a corner. But I think, James, they still have another weapon. And the other weapon is direct bond purchases, direct equity and stock purchases. So I think that if this doesn't work, if the stimulus doesn't work to get us out of this mess, they're going to start going directly and purchasing underlying assets.
Yeah, well, that's interesting.
Sorry for that long answer, but I wanted to kind of give you the whole.
Oh no, I like a long answer. It's very nuanced, and it inspires further thinking. Part of the report from the Fed also indicated that the 5 special purpose vehicles that they had structured with Treasury capitalization to support the corporate bond market, those have now all been unwound and are sitting idle, uncapitalized, because the Fed never had to wade into the corporate bond market, though clearly that was the preparation. Really? You think we're going to stop with stimulus? No, we can prop up prices directly by being the buyer of last resort, not just the lender of last resort.
Yeah.
So okay. So there is that addition. That's basically an additional weapon.
Yeah.
That obviously, that's really something to think about. So
that's
Roger,
why we're
gonna have
here.
to leave it there for now. Yeah, exactly. We're going to leave it there for now, but let's carry on this conversation next week and
Great
let's
discussion.
see where these. Yeah, it was a great discussion. I wish we had more time, but we don't. So thank you for joining me again today, Roger. I look forward to speaking to you on Monday and throughout the week next week. I hope you have a fantastic weekend.
You too. Have a great weekend. Bye. And thanks for having me on.
Bye.